So this is the story of Silicon Valley Bank, which collapsed in just 2 days. The bank had roughly about $209 billion in assets and $175 billion in deposits. So the Silicon Valley Bank majorly worked with startups. 175 billion of these deposits mostly came from the startups. So back in 2020 and 2021, SVB saw a huge inflow of deposits. Interest rates were low and startups were getting easy funding. SVB invested this excess money in bonds, which typically mature in 10 years at the rate of 1.7% interest rate. Interest rates were low in 2020 and 2021. You know, bond prices are inversely proportional to interest rates. So when interest rates move up, bond prices fall. So when US Fed had dramatically raised interest rates from 0% to about 4.75% in last 10 months, the bond value of SVB bonds started to fall sharply. At the same time, the VC funding of all startups fell sharply. That's why layoffs are happening right now. So as startups required money, they were also withdrawing their deposits from SVB. So SVB found itself short on cash, hence it started selling its bonds portfolio at a loss. It sold $21 billion of portfolio at about $1.8 billion loss. It also tried raising $1.25 billion through the stock market, but failed terribly. These two incidents meant that the bank was in trouble. The panic caused more startups to withdraw money. The stocks collapsed at 60% in one day, wiping out $80 billion in value. The interesting fact here is Silicon Valley Bank CEO, CFO, and CMO sold 4.4 million in stock over last 2 weeks. As of now, the bank is shut down and now under the control of the Federal Deposit Insurance Corporation, which is also called FDIC.